So the next item that we're going to cover is getting to the rates. So taxable income, we've just calculated, right? So that's the gross income minus for AGI minus from AGI. Taxable income, to multiply that by a rate, these are last year's rate schedules. As you can see, there's a rate schedule for single, married filing joint, married filing separate, head of household. We'll talk about what those mean here shortly before the video's over. And you can see that they differ ever so slightly from one another. Different filing status pays tax at different rates. And it's not, if you look, the rates are always the same, 12 to 37%. It's the brackets that are redefined. Take note that married filing joint, the first bracket goes to 19,750. That's double what the single bracket goes to, 9875. That's pretty consistent as you march your way up through all the brackets, but not all of them. As you see when you get towards the upper end, it starts to deviate from that measure. The 2021 rates are in your table pack, and the reason I'm not showing them here is because I want to make sure you're aware that you have a table pack posted out in Canvas under helpful documents. Be sure to have that handy most of the time. Of course, you can always access it in PDF, but it is what you will get during your exams. So I think it's useful to get used to using those tables in the rate pack. So there's actually a difference between what we've been looking at. Let's go back a couple. This is called the tax rate schedule. This is a tax table. So tax tables are what you are required to use when your taxable income is through $100,000. So if you look back, that's why I chucked this particular version of the tax rate schedules in. You'll see that there's a break point at 100,000 in each one of these tables. And that's because 100,000 is where you would convert over. And you see an asterisk next to the right on the right-hand side by each one of these that's below 100,000. And if you read the footnote at the bottom, it says it's because you're required to use these tax tables. These tax tables are published as part of the Form 1040 instructions every year. And you can see they break it down by basically $50 increments that you're required to go figure out which $50 increment you're in. And then again, you see the different filing status across the top: single, married filing joint, filing separate, head of household. And then you pull that particular tax number. And the idea is that's supposed to save the mechanics of having to do the calculation. Then we roll into credits. Now, we're not going to spend a lot of time on credits, but I do want you to understand, certainly at this point, how a credit differs from a deduction. So let's start on the left-hand side where we've got gross income of $100 and a deduction. Gross income of $1,000 and deduction of $100. That brings us down to taxable income of $900. Multiplied by 30% gives us tax of $270. And so if you think about it, what happens is that $100 deduction generates $30 of tax savings, right? Because ultimately that $100 reduces taxable income times 30%. That's how a deduction works. It's based on your tax rate and the amount of the deduction. A credit, on the other hand, is a dollar-for-dollar reduction in your liability. So in the right-hand column, you'll see we have $1,000 of gross income and taxable income because there's no deduction. Multiply that by 30%. The tax would be $300. And notice we get a dollar-for-dollar reduction from that credit of $100, and it brings our tax down to $200. So generally speaking, credits are thought to be worth more than deductions. So we can expand that a little bit if we wanted to and see how credit provides a stable amount of reduction in taxes, whereas a deduction does not. So notice in deduction 1 and 2, the only difference is the tax rate. And you can see that the tax rate savings is going to be very different. I'm going to save $30 at 30%. I'm only going to save $10 at 10%. And so if you're in a lower income bracket, one of the things you might go to your political representative and say is, hey, these deductions favor the rich because they're at a 30% rate and I'm only at a 10% rate. And therefore, you're generating more tax savings for them. And that would be true. And so you might instead favor a credit. And you can see that irrespective of your rate, your credit is still $100. And so if you're low income, that credit gives you equal footing or parity, at least from, certain economic perspectives, with high income taxpayers in terms of the tax benefit you reap from a credit versus a deduction. Okay. So we do have a pay-as-you-go system. Individuals have a filing deadline of April 15. Corporations generally file on April 15 as well. Partnerships generally are due on March 15, and payments of taxes are not due on these same dates. They're actually generally due as paid during the year. And in fact, there's a payment schedule for individuals and corporations that reflect the amount they're supposed to pay in every quarter and by when. And we'll eventually get to that detail. I'm not sure why that slide was in there. It got stuck in for no reason other than I guess we're supposed to pay our taxes as we go. So there's to explode a little more on credits. There's also refundable credits and non-refundable credits. So a non-refundable credit is a credit against your taxes up to the amount of tax, but it's never more than that. Whereas a refundable credit is actually both a credit against your tax liability and perhaps an additional amount. And we think of that as you're being refunded money. Well, that's not the reality. You're getting all your refund. You're also getting more on top of that. So, for example, the Earned Income Tax Credit. And for 2021, the Child Tax Credit and the Child Independent Care Credit, both of those are refundable, which means that if you have fairly low tax liability, you can still claim the entire credit, even when it exceeds your tax. So just to let's take a quick comparison. Let's go to column 3, non-refundable credit. 10,000 of income, 30% rate. And let's say that individual has $2,800 of credits. Well, you can see that that's going to bring their net tax down to $200. And if they've paid $400 out of withholding or estimated payments during the year, their refund is $200. If we look in column 4, you see that their non-refundable credits are $3,200. So in this case, the net tax is 0, right? They do not get to credit off more than the $3,000 of tax liability they have, which means their refund is the $400 and that's it, right? They're not getting that additional $200. Now, when we go to the 5th column and we have a refundable credit, what you'd see is that you're eligible to apply the credit above and beyond the next tax. So actually, let's go to the last column. We'll skip that second to last. And you can see that the net tax is $2,000, but then there are refundable credits of $2,500. What happens is that excess $500 is refundable as well. So if we end up with net tax of $2,000 with refundable credits of $2,500 and payments of $400, you basically treat all of that like payments, and this taxpayer can get back $900. So there's no limit on the credit that they can claim if it's refundable.